This is Professor Hazara, and this is the second video in contemporary hedging of foreign exchange transactions. Like I said in the first video, there's now two types of hedges: cash flow hedges, which we'll do in this video, and there's going to be a long video, by the way. I warned you about that last video, and then fair market value hedges. Now, cash flow hedges are typically used to hedge in a receivable or payable in a short-term transaction. Okay, and I'm going to get right into this in here. Remember, there's two rules for cash flow hedges that I talked about last time. Number one is gains and losses, exchange gains and losses close to OCI. They basically clear themselves out. And then premium and discount is amortized using the effective interest method, which can make this into sort of a pain. But in this example, at least, I've this a little easier. Okay, now let's get started. Okay, so we have a transaction here. Okay, on November 1, 2015, a U.S. company sells and delivers 10,000 teapots to a British firm for 100,000 British pounds. That's transaction 1A. In order to hedge transaction, enters into a 9-day forward contract because it's a 3-month contract. 3-month transaction, 3-month contract. So 90-day forward contract means that you're going to use the predicted market price 3 months down the road, 9 days down the road. Okay, and the assumed forward spot and forward rates are as follows. Okay, and this table right here, I've replicated it right out here so I can refer to it in Excel terms. Okay, so on these two tables are exactly the same thing. Okay, transaction 2, basically end of year 2015, U.S. firm closes the books. At this date, the firm must do a bunch of stuff. The usual, adjust the receivable, reclass the receivable that you didn't do last time. You got to record the gain or loss on the forward contract, which should somewhat offset it here. And then finally, you're going to amortize the premium. And then on transaction 3, you're going to close everything out. Okay, so let's go ahead and start here. We're going to make two assumptions. The first assumption is that the interest rate is 12%. We know that's unrealistic nowadays, but let's make that assumption because there's 12 months in a year. And N is equal to 3 months, basically, running from November 1st until January 31st, which is the last day it's the settlement date. Now let's look at these rates here. So I've got the 3 important dates of the contract right here, and then I've got the spot rate, $1.50. These are dollars. $1.50, 60, 70. Your spot rate. So the spot rate is going up. The 60-day forward rate is as of November 1st. The 60-day forward rate going forward is $1.45. I don't know if that's even relevant. This $1.55 will be relevant. Or excuse me, I should put here. Actually, I put the wrong label here. If you look at here, it says 9-day forward rate. That is relevant. This is the 9-day forward rate. Okay. Anyway, so let's go ahead. I'm going to save that. Okay, so let's go ahead, and we've got the assumptions. We know we'll just assume an interest rate of 12% and the contract, so 3% here. Okay, now, like I said before, and I'm going to do this sort of partially for you in the homework, is the rule is now, and it's a bit of a pain, and your book doesn't do this, but the CPA exam might, so that's why I'm doing this, is that premium or discount, in the old method, you could just amortize them straight line. Now you have to use the effective interest method, okay? And so what I'm doing here is I've constructed a little amortization table, and I'll let it construct itself. And then I'll show you the formula that I used. I'll show you this formula here, which is just a recalculation. It's just one of the basic formulas in finance to get an interest rate derived from present value formulas. Then you'll get an implied interest rate, which is the interest rate I'm going to use down here. Okay, but let's start off. The first step here would be, let's compute the discount on the forward contract here. I'll put this in red here. Okay, so we need to know the discount, then we can make the amortization table so that we can then amortize the entries below. Okay, so the total number of pounds sold forward, according to the transaction up here, total number of pounds sold forward is 100,000 British pounds. So we will put 100,000 right here, and we'll call them, we'll take the dollar sign out of there. I'm going to take the dollar sign out of here. and convert the dollar sign into British pounds there. There's your British pounds. Okay, now we've got the fixed forward rate and the spot rate. And remember what I said in the other videos. If the forward rate is less than the spot rate, you call this thing a discount. If the forward rate is greater than, then it's premium. Whether it constitutes an expense or ultimate revenue depends on whether you're paying or receiving money, and that can give you a headache. But anyway, always remember, fixed forward rate being less, discount, greater, premium. Okay, so we know the fixed forward rate is, let's see, the fixed forward rate is going to be this rate right here, $1.45. And the way I know that is that this whole transaction lasts 9 days from November 1st, 15 to January 1st, 16. And as of November 1st, 15, 9-day forward rate is $1.45. Okay, so we'll go ahead and plug that into here. There's your fixed forward rate as of this time frame. Okay, and the spot rate, we know that the spot rate is $1.50. Okay, so discount, like we calculated last time, is going to be that number right there. And I'll just go ahead and take that number, is equal to the units foreign currency times the difference between, let's say the forward rate minus the spot rate gives you that number right there, negative 5,000. We may change that to a pound, it doesn't matter. Okay, and notice that this this whole table down here fills itself in. And I'm going to, just because I don't want you making fancy amortization tables, it really doesn't take that much, but it can give you a bit of a headache. So the sheet that I give you, once you fill in the discount, this will fill in. But you'll be able to see the formulas. And the formulas, this formula is what I use to compute. It's basically where discount is using the discounted, the present value formula for an amount and solving it for the interest rate. But you'll notice that basically it's all those numbers right there. And you'll notice the formula's right there, and I just use those numbers. So it's R is equal to negative times fixed forward rate divided by spot rate times 1 divided by N, which is 3, I believe, which should be, let's see what we got here, C24, which is 3. There you go, so C24 minus 1, so I could do that right there. And then the amortization table for the discount, all it is you're going to take this applied interest rate right here, start with your carrying value. And the carrying value is 150. It's basically the amount of your initial account receivable, okay, which is 100,000 British pounds times the spot rate. And then what you're going to do is you're just going to take that number times the carrying value. Okay, it comes down. So your discount amount of discount amortization for each month is just the previous carrying value times the effective interest, the rate, and then this number here is just the difference. It's like a very simple bond table. And then your next discount amount is the previous year's carrying value times the discount rate. Then you reduce it by 1666 here, and the same thing here, and finally you get the same thing there. So that's your discount right there. That's your amortization, and it's these amounts. Got 3 months, and these are the amounts we're going to use to amortize over 3 months, and it comes to a sum of it's the difference between 150 and 145 for the sum of those 3 numbers right there. Your total discount is going to be 5,000 amortized. Okay, so now let's go down here, and I'm going to divide these dates here. So what I'm going to do is I'm going to put a line right here, and that's the first date. That's when this whole contract is initiated. And I'm going to put a line. Hopefully I don't have to insert any row here, but I'll put a line right here. This between these 2 lines here, your year-end adjustments, and then finally these last entries here. You see there's quite a bit of them. These last entries here are the settlement entries. Okay, so the first thing you do is they sell a bunch of teapots to a British firm. Okay, it's foreign currency. Now this is going to be exactly like in the other examples. The amount of foreign currency, we can just go up here, is $100,000, and I'm going to see if I can use this table here. And initially, this is the spot rate. Spot rate is equal to $1.50. The spot rate is $1.50. Okay, so the initial value of your accounts receivable is 100,000 British pounds times $1.50, or $150,000 for that amount. So that's kind of like it. Notice that I did not record a forward contract like would have in the old standards. In the new standards, you like you to just record the gains or losses as you go along. The gain or loss offsets each other. Okay, so now let's change it to 0. Okay, and so this is 0. So let's do this. You have an exchange gain here. Okay, and it's going to be an exchange gain on account receivable. It's keep in mind that on this transaction, you sold something to a British firm, and the transaction, they settled by paying you 100,000 British pounds, which you're going to take to the exchange broker at the end of all this, exchange it. Okay? And so the logic is still the same. So so the spot rate, let's see how the spot rate changes. The spot rate on this thing went from $1.50, which was the original spot rate. The year-end spot rate is $1.60. So each pound is worth 10 more cents to you. So it looks like we should have an exchange gain of $100,000. Okay, so let's do this. Our base number is still 100,000 British pounds. Our spot rate, our current spot rate is $1.60. Our former spot rate right there is $1.50. So it looks like we're going to make our receivables worth 10 cents more for each pound. Okay, so we'll just go ahead and compute this to increase. Going to be 100,000 British pounds equal to 100,000 British pounds times the difference between $1.60 and $1.50. $10,000. $10,000 is our gain. Now we have hedged this. This thing has been hedged. We did, under the old standards, you would have had that nice initial recording of the contract. We don't do that anymore. They like you to record the gain or the loss just on the contract, on the forward contract, in this case, a contract payable, directly right, without recording the separate forward contract payable, receivable, without recording the fixed part, basically. Okay, so what's going to happen here is we know from the old examples that when you have a gain on account receivable, what you're going to do is you're going to have a loss on a contract payable, which is opposite. Okay, so just knowing that helps. And we're going to go ahead, I'm going to go ahead and record that and say, well, look, one's offsetting the other one. But remember, this has to be done at the, this has to be done using the effective interest method now. We're going to actually, everything's going to be done using the effective interest method. So that's going to complicate things a little bit, but it'll all wash out in the end. Okay, so let's start first of all. We have an exchange on account receivable, which is denominated foreign currency. We know we have a contract payable just because we know we signed a contract. And we're going to have an exchange loss. Notice we're putting this into OCI, but we'll reclassify this $10,000 into OCI here, and that'll basically wash out. But what the FASB likes to do now is, and it goes to the standards on accounting for financial instruments and derivatives, basically. They all have to be recorded using the effective interest approach. So I'm going to get my loss here. So I'll get my loss here, and what I'll do is it'll be the loss like we did last time. As a matter of fact, it's and then what we're going to do is we're going to discount it using the present value formula right there. Okay, so we know that our base number is 100,000 British pounds. Okay, now when you sign this contract, it was on November 1st and November 2nd. I put November 2nd here. Sometimes you do that, but it's basically November 1st. When you sign this contract, the 90-day forward rate, the predicted rate was $1.45. That's how much the contract was worth at that date, basically. That reflects the value of the contract at that date. So we'll go ahead and plug that number in. But the thing is, you sign this contract on November 1st or 2nd, let's say, and 60 days have gone by. So there's only 30 days left in the contract. So now the value of the contract is now based on the 30-day forward rate at December 31st, which is why I put that there. So in a sense, this is, you have a loss on this contract, okay? And you know it's a loss for two reasons. Number one is, well, I'll get to that in a second, but let's compute this. It's 100,000 times the difference between 145 minus 55. So the value of a forward contract is now $10,000 less, and that's the loss that we're going to reflect over here. Basically, what we're doing is these are the mark-to-market principles for derivative contracts in a sense. Okay, so what you're saying here is that originally, looking forward 90 days, the contract was worth $1.45, and now it's worth $1.55. And since it's a payable, from that perspective, it's a loss because you're giving up. Now you're saying that that to obtain a payable, each one of these 100,000 British pounds, it would cost you $1.45. It's going to cost you $1.55. So using the same logic, going back to the original standards, old standards, it's a loss. Okay, and we're going to plug that loss in here. Unfortunately, the FASB likes you. This is finance. Likes you to use the effective interest approach. And what we're doing here is saying that that loss will be realized in 1 month, okay, which is you're going from December 31st to January 31st. So that's why I counted for 1 month. R, by the way, R here is equal to 12%. I should have plugged it in here, but I didn't. So R is equal to 0.12, and that assumption was made. Recall, this assumption was made right here. I should have plugged it in there. I should have flugged that. So sorry about that. But anyway, so the factor that you're going to use is you're discounting the loss that you're going to realize in 1 month by 1 month at 12%. Okay? And so the present value of the loss is 10,000 times that, which means you're going to the present value of your loss is that right there. Okay, now the loss is going to be entered. Everything is going to go into other comprehensive income. So the loss is negative here. The loss is going to go right there. I took out the negative sign because you can have negatives. And then your contract payable, saying is the contract payable has a value of 9,900. It's really 10,000. Think of this as 10,000. You could have put 10,000 there. However, since it's not going to be realized for a month, we discounted by 1 month using this is the regular amount formula. We divide by 12 because we're doing it on a monthly basis. So that's 9,900. Okay, so that's the first two entries. So the first entry is to record gain on accounts receivable, record the loss on accounts on the contract payable, which is somewhat similar to the close, except discounted accounts receivable. And then we're just going to do two other things, and you're going to see a repetition when we get to the final of this. Next thing we're going to do is the rule for cash flow hedges is all gains and losses are closed to OCI. So all gains and losses are closed to OCI. So what we're going to do is we're going to take this gain here. We're going to do it in the last part of this too. We're going to take that gain there and we're going to close it to OCI. So we're going to take this gain here, make it 0, and we're going to transfer it to OCI. So what you have here is, so far you've got an account receivable which has been written up by $10,000, okay, and then you've got an exchange gain which has been zeroed out. Notice the exchange gain is 0. So the only thing you've got basically is OCI has a credit for 10,000 and a debit for 9,900, which is really almost 10,000, but you discounted it back. Okay, and the final thing we're going to do is we're going to amortize the premium. We're going to do 2 years of the discount in this case. I should change this. This is discount amortization. So this is going to be discount amortization. And we're doing this on the effective interest, first 2 years of discount, say discount amortization expense. Okay, and this amount here is going to be for it's going to be for the first 2 months. I should say first 2 months. So used to doing things by years. First 2 months of the amortization. And this is why I did the amortization table, so that we would not worry too much about this. So the first 2 months of the amortization, we're going to amortize $1,685 the first month, and we're going to amortize $1,666 the next month. And so our total amortization is $1,352.13 and then $1,352.13. Okay, so that takes us now down to the last date here, and the last date is the settlement date. Okay, and so it's going to be the same logic, but in these new standards, it doesn't come out as sort of cleanly, nicely as it did under the old standards. Okay, but what's going to happen, what the flow of this is happening, is that you are now going to collect the British pounds, from the British firm, because you sold them 100,000 pounds worth of tea kettles or whatever. You're going to take that to the exchange broker, and the exchange broker is going to collect those and give you back the fixed forward rate of $1.45 on those British pounds. Okay, so let's go down here. First thing to do is you're going to collect, should be a collection. There it is. Okay, so the first thing to do is you're going to collect cash on the British pounds. Now the spot rate at 131 at January 31/16. Let's go up to our little table up here. Spot rate at January 31/16 is $1.70 at the spot rate. Okay, and we'll use the same spot rate right there. And then this number here was the last amount that we adjusted the accounts receivable to, which is basically that number right there. It's just exactly like we did. So a lot of the logic does hold true. So this entry is very similar to the old entries. It is like the old entries. Okay, so first thing we're going to do is we're going to collect our cash we're going to collect our British pounds, and it does say foreign currency there. So you're going to be holding on to British pounds, but they're going to be worth $170,000, which is 100,000 British pounds times $1.70. We're going to record an exchange gain here because each one is now worth 10 cents more. So we're going to record an exchange gain it's going to be 100,000 British pounds times $1.70 less minus the latest adjustment previously, which is $1.60. I'm going to make this 0 again to emphasize what the purpose of that next entry is. And then we're going to write off the balance of the account receivable. Now, the balance of the account receivable, there's just no room to put up T accounts here. The balance of the account receivable was 150,000 plus 160 right there. We're writing it off, which is 160,000. Another way to look at it, it's equal to 100,000 times the last time you adjusted it up, which is that $1.60 right there. So you could also calculate it that way. Okay, so your account receivable now has a balance of 0. So the British firm has fulfilled its obligation to you. You're sitting on $100,000 worth of British pounds there. Okay, so now what we're going to do is take that exchange gain, just like we did before. We're going to take this exchange gain, make it 0, and we're going to put it into OCI, other comprehensive income. Okay, and so, but you're still sitting on, don't forget, 100,000 units British pounds. Okay, so in these next transactions, we're going to take the British pounds and give them to the exchange broker. The first thing we want to do, though, is we want to make sure that the forward contract has been adjusted to its latest value. Okay, and the latest value of the forward contract is going to be based on, well, the transaction is now closed. Okay, so we're going to base it on difference on 100,000 units of foreign currency. So this is 100,000 units of foreign currency. Okay, and the spot rate on January 30th, which was the date that we adjusted the forward contract up here. We made this spot rate on January 30th. Well, we will use the 9-day forward rate. Spot rate on January 30th was is $1.70. We just use that. There it is right there. That's good. Okay, and then the total loss on the forward contract was, we're going to look at the total loss, is based on, way up here, $1.45 9-day forward rate as of December 31st. Okay, so the total loss on the forward contract is, because originally the market was saying 90 days from November 2nd, the value is going to be $1.45, so $145,000 is going to be the worth of 100,000 British pounds. The reality turned out to be that they're worth 170, and this is a loss because this is payable. This is your total loss. Okay, so we're going to take 100,000 and multiply it times the $1.70, which is the actual final rate, spot rate, and the predicted rate. So the market was 25 cents off. So you ended up 25% of 100,000 was your loss. Okay, now the adjustment that we have to make, we've already recorded a loss on this transaction of, we go up here, of that loss, we already recorded $9,999.99. So the way I'm going to record this loss is the amount of the additional loss we have to record is, we have to take your total loss, which is the amount you lost. The forward contract, because it's payable, end up losing you 25 cents. You have to give up 100,000 British units of foreign currency, which are worth 25 cents more than they would have been. Or you could say it costs you 25 cents more to get a hold of it, or whatever, but you're giving up something more of value. Okay, so we're going to take, but we've already recorded 9,900, so we're going to take that number right there, 25,000. We're going to subtract out the fact that we've already recorded 9,900 of this. So the loss that we're going to record, the final loss we're going to record, is 15,099. But the total of the 15,099 and that amount right there is your $25,000 total loss on the forward contract payable. If it had been a contract receivable, you would have actually made money on it. Okay? Then we have to finally, we're still sitting on, keep in mind, we're still sitting on these $170,000 worth of foreign currency right here. Okay, and so what we're going to do is we're going to pay the exchange broker. Now we're not going to pay the exchange broker. We're not going to show that we're paying him $170,000. What we're going to do is, when we pay this thing, we're going to show the value of the contract. The value of the contract is going to be equal to the $25,000. So you could either take this amount and multiply it by that amount. This thing is being settled on a net basis. We're going to pay the exchange broker $25,000, and notice that that amount is the amount that was in the contract payable. We're going to pay 25. We're going to pay 15 plus this amount here. I want to see. You see, we added to get this contract payable. We added those two numbers there, which is really the amount, the value of a forward contract, 25,000 contract payable. Okay, so in a sense, taking out the contract payable, you end up losing money, but it was offset against some exchange gains there. And finally, we got to amortize the premium, and the premium is just going to be amortized for the final month. And there's an amortization table here, so you're going to amortize the premium for 1647 and 1647. Okay, so ultimately, let's see what happens. And I'm going to ultimately, here's what, and I'm going to have you do this in the problem itself, is change the numbers a little bit, you'll do a problem like this, is let's see what happens to both OCI. Let's see the result of all these transactions to OCI and to net income in all these. So let's say we're going to go to OCI and we're going to have the debit. There's a debit on 12/31 to OCI, and there's two credits apparently. On 12/31/15, there's a debit to OCI for 99,099, and there's a credit to OCI on 12/31/15 for 10,000. That's on the contract. That's the reclass entry. And then there's a credit here for 33.52. Okay, then on January 31st, we had a credit to OCI for 10,000, right there. We had a debit here for 15.99. And finally, you had a credit here to OCI on January 31st for the final credit is for 1647. Okay, so let me just check this. This is adding 25, and this should, the 25, it looks like this. So if you sum these up, you will see that they both add up to 25,000, and the impact on OCI is 0. The impact on OCI is 0. Now let's look at the income effect. What are the things that were closed to income? Well, these are exchange gains and losses that would have been closed to your income statement. So there was the initial gain on the account receivable, and then we had a debit for 10,000 on 12/31. Just a minute. Yeah, there it is right there. For 10,000. Then we had the exchange loss for 33.52. Okay, then we come to the settlement date, and you'll see the pattern is the same. You have one credit, two debits. You have the credit here, also credit on your account receivable adjustment for 10,000, and then had a debit for 10,000, which was the reclass entry. We had a debit here to exchange rate. This is your 10,000. This is the one that is offsetting that, so it makes it 0. And then our final debit income is for the exchange loss down here for 1647. Okay, so let's add these things up and see what the income effect we get. Sum of this is 25,000, and obviously the sum of these two is 20,000. So the only income effect was the premium amortization. So after all was said and done, the income effect was just the premium amortization. The you and and keep in mind, basically, the premium amortization is it's the difference. Obviously, it's the difference between your debits and your credits here. But keep in mind that in the income, you have these two credits, which were both, I'm going to go up here, were both, just a minute here, I'm the wrong one here. Why did you take it from the wrong one? D58. There's your exchange gain. They were both the exchange gains. The income effect was both these exchange gains here, which is the 10,000, which was valued 10,000, which was ultimately the difference between $1.70, which was your initial spot rate, and $1.50, which was your initial value. So your total gain on the account receivable was 10,000. However, the total loss on the contract payable, on the forward contract payable, was 25,000, which is 100,000, which is based on $1.70, but instead of being valued at the spot rate of $1.50, it was valued at the forward rate of $1.45. So ultimately, your total loss on that was 25,000. So basically, what you're looking at is these two gains on the receivables. The two losses, the total loss on the contract on the contract payable is also 20 and 20, but it also includes that discount. So that's 25,000. This 25,000 is equal to the $100,000 which the contract had. It was originally valued at $170,000. However, the final value, or excuse me, it was originally valued at $145,000. However, the final value is $170,000. So the loss in the contract is the difference between $100,000 valued at $170,000 valued at $1.45, and it's broken up into these pieces right here, these two 10,000s plus the premium gain. That's basically that. So this really is this basically once you get really into this, it's this right here is I'm going to put here loss on forward contract. That's what you ended up getting right there. And this right here, you end up getting is the loss or the gain on the account receivable. And the difference ultimately turns out to be $5,000. And that $5,000 really, if you get down to it, that $5,000 when you get everything else is really the difference. It's the $100,000. And I'll put this here. And I'll stop there. But that ultimately is just the 100,000 units foreign currency times the difference between the $1.50 initial spot rate and the $1.45, which is it turns out to be the premium, the discount of the forward contract in this case. That's what it turns out to be. That's the only thing equals premium on forward contract. I think this example is really done with discount. I'm going to put changes to income effect equals discount amortization. This stuff can be confusing. Believe me, it's confusing to me still. But the more I do it, the more you get used to it. I'm just trying to get you to understand the concepts. I'm going to use, rather than putting this on the file, I'm going to put it on this bright space exercise with changing the numbers. So that'll make your life easy. But as long as you know the old stuff, start getting to know the new stuff, that'll help you a bit along with the chapter reading. And I've never seen, to be honest about it, I've never seen a chapter in any book cover this cleanly at all. It's just, these were a lot of accounting standards that were thrown together, and the messiness of the accounting also reflects the messiness of the way the standards were made. Okay, anyway, so I'm going to put this up, and then we'll finish with a hedge on a fair market. We'll finish with a fair market value hedge. Thank you very much.